Nebius Group, ticker NBIS, is trading live right now at 104.95 USD. That's a sharp move at the open, already climbing 2.67% just minutes into the trading session on November 12th. It gapped up from its previous close of 102.22 and has already tested the 105.00 mark with an open of 104.32. This isn't just drifting with the market, this is targeted buying pressure. What's fascinating about this immediate jump isn't just the percentage gain, it's the context. The market's broad expectation for NBIS has been a straightforward, if aggressive, growth story. Investors see it as a specialized AI infrastructure and cloud provider, a picks and shovels play for the high-performance computing boom. The stock's spectacular run from a 52-week low of 17.38 to these triple-digit levels is held up as proof of this narrative. The market has been willing to accept a high-flying price-to-earnings ratio, which stands at 84.44, as the necessary cost of admission for a company in this high-demand sector. The belief is that you are buying future growth, not present value. But the reality of this morning's move and the stock's recent behavior is far more complex and signals a significant disagreement in the market. This 105.00 level is a major psychological and technical resistance point. While the buying is active, the volume isn't at a blowout level, suggesting institutions are testing the waters, not piling in with full conviction. The reality is that Nebius is caught in a tug-of-war. On one side, you have the powerful AI growth narrative. On the other, you have extreme valuation concerns, a $2.57 billion market cap, assuming the KSER in the data feed is a regional data artifact for billion, and the shadow of massive entrenched competition. This morning's pop could very well be a bull trap designed to draw in breakout chasers before sellers who bought lower take profit. Let's dissect the recent price action to understand this tension. The gap from 102.22 to over 104.30 at the open tells us that news or sentiment shifted overnight. When this happens, the first hour of trading is critical. We are watching to see if this 104-105 range can establish itself as a new floor of support. The low so far today, 102.42, is encouraging for the bulls. It shows that dip buyers immediately stepped in to defend a complete gap fill, keeping the price above yesterday's close. However, we are still significantly below the 52-week high of 141.1. This tells us that the powerful rally that defined this stock's last year has stalled. NBIS has been in a consolidation pattern for weeks, trading sideways. This move today is a direct challenge to the top of that range. If it fails and the stock closes back below 103, it would be a very negative signal, indicating a lack of true buying power to fuel the next leg up. No stock trades in a vacuum, especially not one with an 84 PE ratio. The macroeconomic environment is hostile to companies like this. We are in a higher-for-longer interest rate climate. This puts immense pressure on growth stocks because it makes their distant future earnings less valuable in today's terms. The market has been punishing companies that promise growth but fail to deliver immediate tangible profits. By all traditional metrics, NBIS should be struggling. But it isn't. It's rallying. This is because it's at the center of the other, much more powerful market force, the AI arms race. The demand for computing power, especially GPU-based infrastructure for training models, is so intense that investors are willing to overlook traditional valuation metrics. Nebius is therefore a battlefield stock, representing the clash between high interest rate realities and high-tech AI expectations. This brings us to the other, quieter side of the trade. The short sellers. A PE of 84 on a $2.57 billion company operating in the shadow of Amazon, Google, and Microsoft is a massive target for skeptics, and the data shows they are taking the bait. Short interest in NBIS has been steadily creeping up. It's not at a crisis level that would indicate an imminent squeeze, but the trend is undeniable. These sellers are placing bets that the company's valuation is unsustainable. What is the short thesis exactly? It's that Nebius is just another Me Too cloud provider in a market defined by giants. They are betting that the staggering capital expenditure required to build and maintain AI-capable data centers will crush the company's margins long before the revenue can justify this 105.00 share price. They look at the chart, see a run from 17.38 to 141.1, and they don't see growth. They see a classic speculative bubble. They believe that a single bad earnings report, a slight miss on guidance, or a competitor's price cut will be the pin that bursts it. The 84.PE ratio is not a sign of growth to them, it's a sign of delusion. For investors, it's critical to know how to track this. You need to be watching the cost-to-borrow rate for NBIS shares. This is the fee short sellers must pay to borrow the stock. If this fee starts to spike, it means the supply of lendable shares is drying up and the demand to short the stock is intense. This can be a precursor to a volatile move. You can often find this data through your brokerage platform or specialized data providers. Another key metric is days to cover. This tells you how many days of average trading volume it would take for all the short sellers to buy back their shares and close their positions. A high number, for instance over 5 or 6 days, means the shorts are trapped. If good news hits, they are forced to buy back shares, which adds fuel to the rally. This is the classic short squeeze setup. Right now, the data for NBIS suggests coordinated skepticism, not an all-out panic, but it's a risk that cannot be ignored. What's your take on the rising short interest here? Do you see it as smart analysis of an overvalued stock, or is it just bears getting in the way of a long-term AI story? Let me know your thoughts in the comments. On platforms like X and Reddit, the sentiment is, as you'd expect, the complete opposite. Retail investors are almost exclusively focused on the AI angle. The discussion is filled with comparisons to other successful infrastructure companies. The prevailing narrative there is that the 52-week low of 17.38 was the discovery phase, and the run to 141.1 was the ignition. They view this current consolidation not as a stall, but as a refueling before the next major breakout. There's a strong belief that Nubis's specialized services, perhaps in specific geographic regions or for niche AI workloads, give it a competitive advantage that the old guard analysts are missing. To them, the 84.PE isn't high. It's a discount compared to other more hyped AI names that have no earnings at all. This massive disconnect between the bullish retail narrative and the growing institutional short interest is where the volatility is coming from. One of these two sides is going to be spectacularly wrong. So let's cut through the noise. What does Nubis Group NV actually do? It's a cloud services provider. At its core, it's a utility company for the 21st century. It provides businesses with computing power, data storage, and software services over the internet. Its key differentiator and the entire reason for the AI excitement is its focus on high-performance computing and AI-specific platforms. This means it offers access to the powerful, expensive GPUs from companies like NVIDIA, which are the non-negotiable building blocks for training large language models. The company, which has origins linked with Yandex, has been strategically positioning itself as a key provider in emerging markets, offering advanced cloud solutions where the American titans may have a lighter footprint. This could, in theory, give them a geographic moat. The business model is a mix of subscription and consumption. Clients pay for the services they use. This is a powerful model in a high-growth environment, as a client's spending can scale exponentially as their AI needs grow. But it's a double-edged sword. In an economic slowdown, cloud spend is one of the first and easiest budgets for a company to cut. This makes Nubis's revenue stream potentially volatile and highly sensitive to the health of the tech sector. Its $2.57 billion market cap puts it in the small to mid-cap category. This makes it a speedboat, not an aircraft carrier. It can change direction and accelerate quickly, but it's also far more vulnerable to being capsized by a sudden storm. Looking forward, what are the catalysts that could break this stock out of its range and prove the shorts wrong? The first is obvious: earnings. The next quarterly report will be a make-or-break moment. The market has priced in perfection. Nubis cannot just meet expectations, it has to deliver a significant beat on revenue and, more importantly, raise guidance for the full year. Investors will also be scouring the report for margin compression. If Nubis reports huge revenue growth, but its margins are shrinking because of the high cost of buying GPUs, the stock will be punished. The expectation is growth and a clear path to profitability. The reality is that those two things are often in conflict. The other major catalyst is partnerships. Any announcement that a major AI research lab, a Fortune 500 company, or a government has signed a multi-year 9-figure contract with Nubis for its cloud platform would be a massive validation. It would prove their technology can compete at the highest level and silence the skeptics. This is what the bulls are waiting for. Now, the risks. The primary risk is competition, and it is immense. It is impossible to overstate the market dominance of Amazon AWS, Microsoft Azure, and Google Cloud. Nubis is, for now, fighting for the scraps, even if those scraps are valuable. If these giants decide to compete aggressively on price for the same AI workloads, or if they leverage their existing enterprise relationships, they could starve Nubis of oxygen. The second risk is technology. The AI space is moving at breakneck speed. A new chip design or a different method for training models could emerge that reduces the reliance on the very GPU infrastructure that Nubis has invested billions in. Finally, there's simple execution risk. The company is in a high-growth, high-spend phase. It must manage its cash flow perfectly, funding this expensive expansion without taking on crippling debt or diluting shareholders into oblivion, all while navigating a complex geopolitical landscape given its international operations. This stock has seen an incredible range in the last year, from 17.38 to 141.1. It is a true battleground. I want to know what you think. Comment below